Stock, bond, ETF. These three terms get mentioned constantly in financial news, in retirement plan documents, in conversations about investing. Most people have a rough sense of what they mean. But ask someone to explain exactly what a bond is or what makes an ETF different from a stock, and you'll usually get a lot of hedging and hand-waving. That ends today. In this video, I'm going to explain all three clearly, in plain language, with no jargon. And by the end, you'll understand not just what each one is, but how they work together and which ones belong in your portfolio. Let's start at the beginning. A stock is a share of ownership in a company. When a company wants to raise money, to expand, build new products, hire people, open new locations, one way it can do that is by selling small pieces of ownership to the public. Each piece is called a share of stock. When you buy a share, you become a part owner of that company. A small part, but a real one. Think of it this way. Imagine a local pizza restaurant decides to grow into a chain. The owner needs $1 million to open 10 new locations. Instead of borrowing all of it from a bank, she divides the business into 1 million equal pieces and sells each piece for $1. If you buy 100 pieces, 100 shares, you own 1/10,000th of the business. If the chain grows and becomes worth $5 million, your 100 shares are now worth $500 instead of 100. That growth is your return. Public companies work the same way, just at a much larger scale. When you buy a share of Apple, Microsoft, or any publicly traded company, you're buying a tiny slice of that business. You make money in two ways. First, if the company grows and becomes more valuable, the price of your share rises. That's called capital appreciation. Second, some companies pay a portion of their profits directly to shareholders on a regular basis. Those payments are called dividends. The risk: companies can struggle or fail. A share in a company that loses value is worth less than you paid for it. A share in a company that goes bankrupt could be worth nothing. That's why owning stock in a single company carries significant risk. Your outcome is entirely tied to that one business, which is exactly why diversification matters so much, and why we'll come back to that when we get to ETFs. A bond is a loan, except this time you're the one doing the lending. When a company or a government needs to borrow money, one way they do it is by issuing bonds. A bond is essentially a formal IOU. The borrower promises to pay you a fixed rate of interest, called a coupon, at regular intervals, and to return your original investment at the end of a set term. You're acting as the bank. Here's a simple example. The US government issues a 10-year Treasury bond at 4% interest. You buy $10,000 worth of that bond. Every year for 10 years, the government sends you $400 in interest payments. At the end of 10 years, you get your $10,000 back. Your total return over the decade is $4,000 in interest plus your original principal, guaranteed, assuming the government honors its obligations, which U.S. Treasuries historically have. Corporate bonds work the same way, but issued by companies instead of governments. Because companies carry more risk of default than the U.S. government, they typically offer higher interest rates to attract investors. That higher rate is compensation for the additional risk. Bonds are generally less volatile than stocks. Their value doesn't swing dramatically with market sentiment the way stock prices do. That stability makes them the counterbalance in a portfolio. When stock markets fall sharply, bonds often hold their value or rise, smoothing out the overall impact. The trade-off is that bonds typically produce lower long-term returns than stocks. You're giving up some growth potential in exchange for steadiness. Before we get to ETFs, which is where stocks and bonds come together in the most practical way for most investors, go ahead and drop a like if this is making these concepts clearer than they've been before. Now let's talk about the tool that changed how everyday people invest. An ETF, which stands for Exchange Traded Fund, is a basket of investments that trades on a stock exchange just like a single stock does. Instead of buying one company's stock, when you buy an ETF, you're buying a single share that holds dozens, hundreds, or even thousands of individual stocks or bonds inside it. It's one purchase that gives you instant exposure to a broad collection of investments. The most common type is an index ETF, a fund designed to track a specific market index. An S&P 500 ETF, for example, holds shares of all 500 companies in the S&P 500 index. When you buy one share of that ETF, you're effectively owning a tiny slice of Apple, Microsoft, Amazon, Johnson & Johnson, and 496 other companies, all at once with one transaction. Here's why this is so powerful for the average investor. True diversification across hundreds of companies would be nearly impossible to build on your own. The cost and complexity of buying individual shares of 500 companies is prohibitive. An ETF packages all of that diversification into a single, affordable, easily tradable unit. ETFs also tend to be extremely low cost. Because most index ETFs simply track a predefined list of holdings rather than requiring active management decisions, their operating expenses are minimal. Expense ratios of 0.03% to 0.10% per year are common. That's as little as 30 cents per year on every $1,000 invested. One clarification worth making. ETFs and mutual funds are similar in that both hold baskets of investments. The key differences are that ETFs trade throughout the day at market prices, like a stock, while mutual funds are priced once per day after the market closes. ETFs also tend to have lower minimum investment requirements and lower fees than actively managed mutual funds. Now that you understand what each one is, here's how they fit together in practice. Think of stocks and bonds as the two main ingredients, and ETFs as the most efficient way to hold them. Stocks are the growth engine of a portfolio. Over long time periods, they've historically produced the highest returns of any major asset class. But they come with volatility. In a bad year, a stock-heavy portfolio can drop 30 or 40% before recovering. That recovery may take years. Bonds are the stabilizer. They produce steadier, more predictable returns. When stocks fall sharply, bonds often cushion the blow. They give up some long-term growth in exchange for that steadiness. The ratio of stocks to bonds in your portfolio determines the balance between growth potential and stability. A higher stock percentage means more growth potential and more short-term volatility. A higher bond percentage means steadier performance with lower growth potential over time. ETFs are simply the most practical and cost-efficient way to hold both. A total stock market ETF gives you exposure to the entire U.S. stock market in one fund. A total bond market ETF gives you exposure to a wide range of bonds in one fund. Together, those two ETFs cover the core of a complete investment portfolio. At very low cost, with minimal effort, and with instant diversification across thousands of underlying holdings. So how do you apply this? The short answer is that most investors, especially those in their 40s, 50s, and 60s, don't need to choose between individual stocks, individual bonds, and ETFs. The right approach for most people is to use ETFs to hold both stocks and bonds, and to adjust the ratio based on your age, timeline, and comfort with risk. A common starting point: subtract your age from 110 to get your stock ETF percentage, and put the rest in bond ETFs. At 50, that's roughly 60% stock ETFs and 40% bond ETFs. At 55, closer to 55/45. This is a guideline, not a rule. Your specific situation may call for more or less risk, but it gives you a practical framework to start from. You don't need to be an expert in individual stocks or bonds to build a solid investment portfolio. You need a couple of low-cost ETFs, a consistent contribution schedule, and the discipline to stay invested through market ups and downs. That combination, over 15 or 20 years, is what builds real financial security. Here's the plain English summary. A stock is ownership in a company. It grows with the company but carries risk. A bond is a loan you make to a company or government. It pays steady interest with less volatility but lower long-term growth. An ETF is a basket that holds many stocks or bonds in one investment. It gives you instant diversification at very low cost, and is how most everyday investors should actually hold both. Together, the right mix of stock ETFs and bond ETFs is the foundation of a simple, effective, low-maintenance investment portfolio that most people never need to complicate further. If this channel is helping you build a clearer picture of how investing actually works, subscribe and like. There's a lot more coming. I'll see you in the next